What is stock trading? So stock trading refers to the buying and selling of shares in a company. And that means if you wanted to technically own a piece of Apple as a company, you could. A stock share is simply a piece of ownership in that company. Hence, when you buy shares in a company, technically you own a small portion of that company. By buying and selling stock shares, you can profit from the increase or decrease in a stock's price. The way stock markets work is stocks and shares are simply traded on exchanges. Some of the most famous exchanges are the New York Stock Exchange, the London Exchange. There are many of them. But when you are trading stocks, you are buying and selling the shares through brokers who are linked to the exchanges like the New York Stock Exchange. So you buy and sell these stock shares from your broker. They in turn get them from the exchanges. In terms of how you can make money trading stocks, there are several ways. Number one, you can buy a stock at a lower price and sell it at a higher price. This is one of the most common things that stock traders do. For example, let's say you're a sports fan like I am, and you believe sports betting is going to become big in 2021. You use DraftKings yourself. In case you don't know what it is, it's an app that allows you to do sports betting, bet on sports games and all kinds of things. Currently, the stock for DraftKings is trading around $50. So if you want to buy it at 50 and it goes up to 60, you make a profit. In terms of how much profit you can make on your stock trades, the formula is very simple. It's the share price difference times the number of shares. That's how much you make. So going back to our DraftKings example, if you had bought 10 shares at $50 and the price of DraftKings went up to $60, you would make $10 times the number of shares. $10 times 10 shares, that's $100. If you bought 100 shares of DraftKings, then you'd make $10 per share times that 100 shares, which would equal $1,000. Now, if you're wondering how possible it is to make money like this, consider that DraftKings started the year in 2020 around $9. It ended up at $46 a share. So if you had just bought 100 shares of DraftKings at the start of 2020, by the end of the year, that one stock trade would have made you a $3,700 profit. And that's just one stock. The second way you can make money trading stocks is through dividends. We're not going to cover this too much in detail, but dividends are simply extra shares the company gives you for holding their stock. So if you buy their stock and they have a dividend, they will give you extra shares in their company if you hold it for a certain period of time, usually what they call the dividend period. These vary, but they often pay out every quarter, sometimes every half of the year, sometimes once a year. But a dividend is simply a percentage of the shares they will give you. So if you have a stock that has a 5% dividend and you have 100 shares of that stock, they will give you an additional 5 shares, which is 100 shares times 5%, which is 5 shares. They will give you an extra 5 shares after the dividend closing date. A third way you can make money from trading stocks is by short selling. If you think a stock is going to go down in value, you can short sell the stock, meaning you are speculating that the stock will go down in value. An example of this is in early 2020 when the coronavirus had just hit. We wrote an article in mid to late February about which stocks we thought were going to go down in value. One of those, we felt international travel was going to slow down massively and speculated that airline stocks were going to get hammered. Sure enough, we were right. As stocks like American Airlines went down from like 26 down to 9. Delta went from 55 down to about 19. And United went from $74 down to 24. All of those shares dropped in a matter of weeks. Now, not all stocks can be shorted outright. It's important to understand this, but short selling is another way that you can make money trading stocks. Now that you know the basics of how you can trade stocks and make money from stock trading online, we're going to talk about the stock market hours and trading sessions. Now, there are a lot of stock markets out there, but we'll cover a few so you have an idea. So the New York, which is the one that I trade, this is the main New York or US stock trading session. This is from 9:30 a.m. to 4 p.m. EST or New York time. This is the main trading session in New York. Now, there is also London. It's open from 8 a.m. local time in the UK till 4:30 p.m. This is generally considered to be the largest stock market in the UK EU region. The other big one being the DAX, the German DAX. In Australia, the stock market is open from 10 a.m. local time Sydney to 4 p.m. Now, we put their local times in there, and we've also put the EST hours in just for your reference, but these are some of the major exchanges throughout the world. Our next lesson is about understanding the stock market and market cap. which stands for market capitalization. Market cap is basically the total value of a company based upon the total number of shares times the price per share. So if you were to look at Apple, it has approximately 16.8 billion shares available at around an approximate price of $140 a share. So if you do the math, 16.8 billion times 140 per share gives it a market cap around 2.3 trillion. Now, it's important to understand regarding market cap that there are various types of market caps and stocks you can trade. So using this guide on the screen, there are generally considered to be 6 ranges of market cap. The first one, or the lowest one, being nano cap stocks. These are stocks with less than 50 million in valuation or market cap. Next one is micro, which is 50 to 300 million. Then you have the small caps, which are 300 million to around 2 billion. Mid caps, which are between 2 billion and 10 billion. Large caps, which are between 10 and 300 billion. And mega cap stocks like Apple, Amazon, Facebook, Google, all with market capitalizations of 300 billion and above. Now, you don't have to really know all of the exact market caps. Like, it's not super important that you understand those specifically, but it is important to understand how market cap can and often does affect how the stock trades, how the stock moves. For example, one general rule you can rely upon regarding market cap is the greater the market cap, generally, the lower the volatility. Volatility simply refers to the ability for the price in the stock to change up or down heavily or not, to move, rapidly in price or not. If you think about it, Apple, with such a large market cap, needs a lot of capital just to move its market cap up significantly. It's worth 2.3 trillion, and there's 16.8 billion shares out there. You're going to need a lot of shares and a lot of money to move it heavily in one direction or another. Whereas you compare it to a slightly lower price stock like DraftKings with less shares and a smaller market cap, it doesn't require as much money and capital to move the price. Hence, it can be more volatile. So a general rule is that the greater the market cap, the more often the lower the volatility. This is why market cap is important, because it's helpful to understand what kind of stock you're trading, and based on the share price and the market cap and the number of shares available, whether it has a greater propensity for volatility or not. This also means by default that market cap is often correlated to the number of shares available to trade, which is called the float. Stocks like Apple have billions in shares to trade, as we talked about, around 16.8. Hence, it'd be next to impossible to corner a stock like that or own large amounts of the stock available. But going to our DraftKings stock, it only has approximately 390 million shares in total, and less than that available to trade, probably only around 30 to 40 million shares. And if we go to a smaller stock like Fubo TV, which is the symbol FUBO, this stock only has 67 million shares in total, and likely around 6 or 7 million available. So it's important to understand how smaller stocks have less shares available to trade, which can have implications for how the stock can gain in value or lose in value if there aren't as many shares available to buy or sell. So super important that you just understand this general rule that the larger the market cap, the larger the amount of shares available. Another important point around market cap is to understand the percentage gainers versus losers. Generally, the larger the market cap, the greater the chance the company is profitable. Now, if you think about this, this has to do with it generally having more capital available to generate revenue for its business. Smaller companies by default have less capital and are also less established. So if you think about this, it should be pretty intuitive, as most new businesses struggle just to survive. Many, don't even make it past the first few years, while established businesses like Apple and Google and Facebook, they have incredible brand value. They have products people know about, and they have multiple sources of revenue. Whereas smaller stocks, they tend to lose more than gain because they don't have access to as much capital. They're not, as well known. They have less people spending money in their company. So smaller stocks tend to lose more than gain. If you look at the total number of small stocks that are available in the nano, micro, and small cap market, a huge majority of them will not end the year profitable. Whereas larger cap stocks, they have more capital available, they have a much more established business, they have a greater chance in maintaining value or growing. Now, again, this is a broad generalization, so don't take this to like the nth degree, but the key point is just to get this main idea here, that there is a difference in the percentage of gainers and losers based upon the market capitalization. Lastly, there is this lowest price a stock can be valued at to even be on certain exchanges. So for example, in the NASDAQ, they generally would not allow a stock to remain on an exchange if it's less than $1 in value. So it needs to be at least $1 in value or greater. So for penny stock and small cap stock traders, it's helpful to know this because oftentimes you'll see that when small cap stocks start to lose value and get down to that $1 level, they will often kind of hold the line there and sometimes even rocket up. Not always the case, but you will see it that it happens every now and then. The reason being is that because the company doesn't want their stock to be delisted, that would be very bad. It means people can't invest or buy stock in the company if it's removed from the NASDAQ, or if they can, it makes it much harder to get people buying shares. So what they often do to increase the share price and get away from that line in the sand is they will often buy more shares. And so sometimes this buying will rocket the stock off the $1 line. It's important just to understand this. You won't have to deal with this with larger cap stocks, but when trading smaller cap stocks, there are certain environmental differences that will come into play. Hence, it's important to understand how market cap can affect a stock behavior. Now, before we move on to the next slide, if you haven't already, make sure to subscribe to our channel. And while you're at it, give this video a like to show you found it beneficial so we can keep doing free videos like this. It's your likes and your subscribing to the channel that allows us to do free videos like this for you. Okay, we have a few more key points to cover regarding stock trading, specifically key terms and types of stock trades or orders you can make. When it comes to the stock price, you will often see a price on your stockbroker platform. For example, I use Thinkorswim with TD Ameritrade, and when you look up that stock, you'll see two prices. For example, you could see a stock that is valued at, say, it'll say 10 or 10.05. These two prices are called the bid and the ask, and the difference between them is called the spread. The reason why there's a difference in price in your broker, like the 10.05, is the bottom line is your broker's providing a service. They are allowing you to buy and sell shares as you can't do so directly from the exchanges. So like a business selling any product, they will sell it to you for slightly more than what it costs, and they do that to help cover their costs for providing the service of allowing you to buy and sell stock shares. The bid and the ask, the best way to think about them as these are the implied costs of doing business in essence. So when you see a price like 10.05, the bid is the lower price. So in this case, 10, that's the bid. And the ask is the higher price at 10.05. If you want to buy a stock, you're going to have to buy it from someone who already owns the stock. Hence, in our example of the 10.05, the lowest price that this person will sell to you for is 10.05. If you are looking to sell the same stock, you will get $10 for it. That spread between 10 and 10.05, that 5 cents, that is what the broker profits for helping you find a buyer and seller to execute this transaction. Kind of like a real estate broker brings a buyer and a seller and they get a fee for that. This is kind of the same thing. As a general rule regarding the bid and ask spread, the smaller the spread or the difference between the two prices, the better the liquidity or otherwise known as availability of that particular stock. Now, there are three ways that you can buy and sell stocks. The first way that you can buy and sell stocks is what we call a market order. So market order simply means that you want to buy or sell the stock immediately. Once you hit the button and your broker receives it, it will buy or sell that stock at the current price it has. Now, there are advantages to a market order, and one of those being that you're going to get filled. You hit that market order, if the shares are there, as soon as the broker gets it, they're going to fill you. However, there is a disadvantage to the market order, which is that you may not get filled at the last price you see on your platform, because by the time you send the order and your broker gets it, usually that's within milliseconds, especially if you have a good internet, but the price can change as stock prices change and move fast. So when your broker gets the order, they're going to fill you at the price, at the next price that they have available. So if the price is 10.05 and you hit it at 10.03, by the time it got to them, it's at 10.05. They're just going to fill you at that. So the whole point of a market order is that you use these to get filled as quickly as possible. You may not get filled at the price you want exactly, but you're going to get filled. The second type of order is called a limit order. This is where you can buy or sell the stock at a specific price in the future. So for example, Tesla is trading around $840, $850 at the time of this writing. Let's say you want to buy Tesla if it dips down to $840 flat. So what you can do is you can set a limit order to buy at $840. Now, if Tesla just keeps going up and up and up, price never got down to 840, you're not going to get filled. But if Tesla gets down to 840, then your limit order will get filled and activated. So it'll send the message to the broker, hey, it's at 840, buy it. And if the shares are available at that price, the broker's going to fill you. The third type of order is called a stop loss. This is simply an order to close your trade if it goes up or down to a specific price. So let's go back to Tesla. Let's say you own Tesla at 750. You bought it at 750. You're a smart, savvy stock trader, and you felt Tesla was going to go higher. Well, it's currently around $850. You have a fair amount of profit locked in at this point. You have $100 per share. And let's say you feel like, hey, I got $100 locked in. I don't want to own Tesla anymore if it drops to $825. Well, then what you do is you set a stop loss order at $825 for the same number of shares you own. So if or when in the future Tesla gets down to $825, it will close your trade and lock in the profit at that price. Now, there are more nuanced versions and complex order types out there, but these are the three most important